Hello, my name is Smits. I'm the founder and managing director of the Stock Network, and we're a global investor access platform. We connect companies to investors and we engage investors through simplifying stocks. Today, we're pleased to be bringing you the presentation titled Pre-Market Moves, the real reason that stocks move before the market opens. First, a little bit about me. I'm the managing director and founder of the Stock Network. I'm also a former Wall Street broadcast finance journalist for the Australian Financial Review, and I'm an award-winning entrepreneur for the Capital Network, which is an investor relations firm. Also, a current director of the Australian Shareholders Association and a director of a listed medical device company called Oncosil. I love stocks and investing and am committed to helping make the stock market accessible. Since working as a foreign correspondent for the Australian Financial Review, I worked inside the New York Stock Exchange and NASDAQ in New York and committed myself to investor relations, winning a number of entrepreneurial awards. I've also committed myself to governance, and as I said, I'm a director of two organizations, also a two times winner of Director of the Year award. Understanding the stock market has really changed my life, and I'm now on a mission to help others do the same. Before we learn about the real reason that stocks move before the market opens, I'd also like to introduce the Stock Network. We produce daily stock news focused on the ASX and US markets, CEO interviews, presentations, and expert insights. As a journalist, investor relations advisor, company director, and of course, stock investor myself, I've seen firsthand what companies need to share and what investors want to see. Herein lies our uniqueness. We're using journalism and investor relations professionals to navigate compliance authentically and credibly, doing what AI doesn't, working with legal documents to simplify them and put real humans on screens. Speaking about investors, let's take a look now at global markets and get you a trading edge by understanding just what is happening between official opening and closing times. When we talk about pre-market moves, what we're really seeing is the influence of global markets opening and closing across time zones. Stocks don't react to what happens locally. They're constantly being repriced as information flows from Asia to Europe and to the US. A big move on the Nikkei, Hang Seng, or Germany's DAX can trigger investor sentiment before Wall Street even wakes up. This timeline shows how trading sessions overlap and why market-moving news often hits stocks well before the official bell of the stock market that you're trading in. With the rise of technology, we can now trade in a number of different stock markets at different times, giving investors unprecedented access, flexibility, and opportunity to diversify across global markets in real time. So why do stocks move before the market opens? That's because pre-open and after-hours sessions allow investors to react to global news, earnings announcements, or overnight events before regular trading begins. In the US, extended hours give traders more flexibility, while in Australia, movements in the pre-open session reflect buy and sell orders building up ahead of the 10 a.m. open. These early signs often set the tone for the day. In Australia, stocks can look like they're moving before the market even opens. But what's really happening is order buildup from 7 to 10 a.m. is the pre-open. Traders can place and adjust orders, but no trades actually go through. All that buying and selling pressure stacks up until 10 a.m. when the exchange matches it and sells the opening price. That's why you'll see stocks shift before trading officially begins, even though no money has changed hands yet. In the US, though, it's different. Stocks really can trade before and after the normal session in what's called pre-market and after hours. From as early as 4 a.m. right through to 8 p.m., investors can buy and sell, reacting to overnight news, global markets, or company announcements. The volume's usually lower and the swings can be bigger, but those trades are real, which is why American stocks can jump or dive well before the regular bell. Pre and post market trading often is characterized by thin trading volumes and increased price volatility. The participants in pre and post market trading are mostly professional investors. These are investors like fund managers or hedge funds, algorithmic funds, including algorithmic trading utilizing high frequency trade strategies, and investment banks. The reasons why these groups trade outside of normal trading are many and varied. Often these groups want to immediately react to news flow occurring outside of normal trading. This kind of news flow can include company announcements or quarterly profit results. Also, economic statistics, mainly US stats issued in the pre-open period. And also commodity market trends, remembering that Australia's importance as a supplier of a range of resources, the prices of which are determined in global markets. And finally, offshore macro developments, things like political and economic events occurring in major overseas countries. Professional stock market players can also react to these events by trading in futures and options market products offered by overseas exchanges. When it comes to moving first, who is moving before the market open and why? Well, as I mentioned, really it's dominated by professional traders who are moving quite simply because they are watching markets 24 hours a day, 7 days a week. Once they decide that news flow is market moving, which is not aligning with the consensus view and also not noise, they adjust their positions. Sometimes market traders' actions are fulfillment of stop loss orders that are previously also in place. I think a particularly interesting point to note as we're looking to get our own trading edge is how to speed read stocks. Now, I say this as someone who myself has written thousands and thousands of stories and also even ASX announcements, compliance announcements. This is what traders are looking for when they're reading about stocks and trying to understand them really quickly. When it comes to reading news, they often learn how to scan announcements like a headline race. They're not reading every word, they're searching for those key numbers, the guidance, and also the tone that matters most. In under 60 seconds, they'll check earnings against expectations, look for changes in outlook, and spot anything surprising or off consensus. They strip out the noise, focus only on the market moving details, and instantly compare them to what was priced in. Within that first minute, they've usually made a call, buy, sell, or hold. When traders read the key highlights of an announcement, they first look for anything that diverges from consensus expectations. Consensus is really what everyone thought may be happening that is different to the norm. If the company's explanation doesn't fully offset that surprise, the initial market reaction tends to stick. Often sharp price moves are followed by a more measured phase as profit takers and bargain hunters step in. The main exception is when price-sensitive information isn't upfront. For example, if critical details are buried deeper in a lengthy annual report rather than in the executive summary. Price-sensitive announcements are company updates that could reasonably be expected to move the share price if investors know about them. So you can see on this slide on the ASX, that includes things like earnings results, profit warnings, big contract wins or losses, acquisitions, leadership changes, or regulatory rulings. And on the ASX, they are shown by that red dollar sign that appears next to the announcement because they can affect valuation straight away. Companies are legally required to release this information to the market as soon as it's known so that all investors can have equal access to the information. So whenever you see this red dollar sign, it's a signal that the announcement contains information likely to move the stock price. When these announcements land before the ASX opens, they immediately shape sentiment. Traders and investors digest the news in the pre-open window, which is 7 to 10 a.m., placing buy and sell orders that reflect their reaction. Even though no trades are executed yet, the order imbalance signals how the stock is likely to open. Higher if demand outweighs supply, or lower if selling pressure dominates. By the time 10 a.m. hits, the mood has already been set and the stock can gap up or down at the opening match. When looking at these announcements, it's really important we consider the communication between earnings versus narrative. So, what does move the needle before the bell? It's really a tug of war that exists between earnings and narrative. Which one moves the needle more when it comes to the company's share price? Well, a strong earnings beat often jolts the market, but not always. Occasionally, a company may deliver stellar numbers, yet see its shares stagnate if the figures were already anticipated and backed into the price. This illustrates the buy on the rumor, sell on the fact phenomenon, where expectations drive the move and not the actual results. Conversely, positive earnings can be overshadowed by cautious forward guidance, tampering down investor enthusiasm. In these cases, even upbeat results may yield a muted reaction if management signals uncertainty about the next 6 to 12 months. As noted in the Harvard Business Review, while soft narrative elements like tone and leadership communication can color investor decisions, they don't always override fundamental performance. So when you're trading and when you're looking to get that investor edge, it's an important question you can ask yourself. Am I focused on the earnings or on the narrative, and what's the balance between the two? When it comes to after-hour news, it's helpful to understand how earnings, deals, and news affect local stocks. Sentiment in Australian markets is heavily influenced by overnight developments in the US, European, and Chinese markets. Earnings reports, M&A activity, or macroeconomic updates abroad can really sway ASX futures and early trade. Reuters and CNBC often spotlight how US rate cut expectations or corporate surprises set the tone for markets in Asia and Australia, especially when economic data or geopolitical tensions emerge. This is why newspaper headlines are so important. China's market dynamics are particularly significant for Australia, given China is Australia's largest trading partner. Developments in other key partners such as Japan, South Korea, and India also garner close attention, particularly when news affects commodity demand or export opportunities. Even when the US doesn't directly report, global risk appetite shifts and it spills into the ASX in Australia through currency moves, bond yield, and commodity price channels. Now for a look at algorithms and bots, strategies that trade headlines at lightning speed. Algorithmic trading systems spring into action immediately when news hits the wire, often before human traders even register the headline. MIT Sloan research underscores how machine learning-driven trading strategies are reshaping financial markets, racing to digest data, detect patterns, and execute trades with near zero latency. These algorithms, ranging from ultra-fast arbitrage bots to volume-weighted execution engines, dramatically tighten the window for human reaction, making every millisecond consequential. Investopedia categorizes several key algo strategies that dominate the landscape. Trend-following models chase technical breakouts like moving averages and channel shifts. arbitrage systems hunt price mismatches across markets, sometimes layering in currency conversions with cross-listed stocks. Mean reversion setups bet on pullbacks to average values, and trade execution algorithms like VWAP meticulously split large orders to match typical intraday volume patterns. These tools not only seize opportunities faster than humans, they also redefine liquidity and impact market dynamics in unprecedented ways. It's also important to consider how dividend announcements can spark early buying or selling. Dividend announcements hold considerable sway in Australian stock markets. Many Australian investors prioritise income, especially when dividends are fully franked, providing tax-effective returns. Morningstar data confirms this dynamic, showing that dividends are frequently declared alongside earnings and often before trading begins. This really amplifies their immediate market impact. Especially noteworthy are special dividends, which sometimes arrive as part of M&A, merger and acquisition deals, and can generate sharp share price reactions that are either positive or negative. Australia's dividends land on a global pedestal. The ASX 200's cash yield significantly tops that of many major markets, and when franking credits are included, total yields are about twice what US investors typically receive. So just a reminder, watch out for those dividend announcements and be aware perhaps when a stock that you're invested in or want to invest in is going to announce their dividend. Now, when it comes to red flags, we all need to know the red flags in results that move prices early. Sometimes a company releases news that can worry investors before the stock market even opens. Even these are called red flags, and they make people question if the company's financial results are trustworthy. For example, if a company is using unusual ways to count its sales that are different from its competitors, it could mean that they're making their growth appear better than it may be. Other warning signs include a lot of top managers leaving the company, which suggests a shaky future, or shady deals with people close to the company, which could hide problems or conflicts of interest. You can also find hidden problems by looking closely at a company's financial report. Companies sometimes use overly complicated accounting or confusing business structures or language to hide debt or struggling parts of their business. When investors catch on to these tricks, the stock price can drop really fast, sometimes before the trading day even begins. Learning to spot these red flags helps investors see beyond the simple numbers and understand the true health of the business. Now, when it comes to TSN in action, we really see ourselves as helping the early investor. We're a business news publication, and we're simplifying this complex stock market information for investors. We're aiming to bridge the gap between companies and investors by making company announcements, CEO interviews, and expert analysis more accessible and understandable. We primarily do this by creating unique audio, visual, and written content in both short and long forms, which are distributed across various digital and social media channels. Our goal is really to take the company's equity narrative and transform it from just a set of numbers to this story that can really help investors, both new and experienced, make more informed decisions. This approach is rooted in the belief that financial literacy is crucial for investors' success by providing a platform for companies to communicate their stories and for investors to quickly digest that information. We're really trying to help our community stay ahead. Ultimately, we are a tool that empowers investors to understand the true health of a business by looking beyond the surface level data. When it comes to your morning trading edge, it's really important that you use speed and signals and smarter tools. In final thoughts and your morning edge, the core message is that investors can gain an advantage in the stock market by effectively using speed, understanding these signals, and employing smart tools, especially during the pre-market hours. The idea is to move simply beyond reacting to the market and instead proactively identifying opportunities before the official trading day begins. This involves quickly interpreting news, recognizing those red flags and other indicators discussed earlier, like leveraging resources like the stock network to process information. To truly win the pre-market, investors need to develop a keen eye for relevant information and the ability to act swiftly. This doesn't mean blindly trading, but rather making informed decisions based on a clear understanding of the underlying forces that are moving stocks before the open, as explored throughout this presentation. It's about transforming raw data into accessible insights, enabling the individual investor to achieve a morning edge and participate effectively in the early market movements that often set the tone for the entire trading day. When it comes to the top 3 tips that you should remember to avoid market traps, you can avoid these common traps in pre-market trading by checking for the confirmation of news. A strong news story or announcement combined with high trading volume indicates that many investors agree on the direction of the stock. This gives you the confidence that the price movement is based on solid conviction, not just speculation. In contrast, you should be wary of announcements that seem too good to be true. These are often filled with marketing language, and the real risks or negative details can be hidden in the fine print. To make a smart decision, you should look past the hype and carefully read all the notes and disclosures that are provided by the company. Instead of chasing every bit of market chatter, smart investors focus on identifying the true signals by looking at a company's historical trends. For example, a single positive update might be an isolated event, but if a company has a consistent history of strong upgrades, it suggests a sustainable and positive trend. This approach helps you distinguish between fleeting noise, temporary, unimportant, and genuine signals that indicate that a company's underlying health and future potential are sound. By focusing on confirmed trends, you can make more informed decisions and avoid the traps set by misleading or unconvincing announcements. When it comes to mastering pre-market moves, remember your edge is not speed, it's smart speed. To master pre-market trading, focus on these key strategies. Develop a smart speed mindset. Don't just react to headlines. Instead, use a structured approach to quickly filter out noise and identify meaningful signals. Train yourself to spot key numbers, guidance, and changes in the tone within the company announcements in under a minute, and use the right toolkit. Remember, beware of those red flags. Actively look for warnings like aggressive accounting, leadership changes, or related party transactions, which signal underlying problems. Remember that balance between earnings and narrative. Distinguish between a company's positive spin, which is its narrative, and the actual financial performance, which are earnings. Sometimes great earnings are overshadowed by a negative outlook and vice versa. Pay close attention to those dividend announcements, especially special dividends, as they can cause sharp price movements. And finally, harness technology. Use smart tools and platforms that provide pre-market data. While you may not be an algorithmic trader, These tools help you access information as quickly as possible. The goal is to move as early and as wisely as possible, using data to inform your decisions rather than relying on emotion or hearsay. When it comes to the stock network, we're simplifying these announcements through news, interviews, events, and also articles. And I would invite you to go on our website or follow any one of our social media platforms. We're on them all. We are now distributing to more than 300,000 investors, and we would love to have you be involved as a community member or a contributor or a distribution partner. Please get in touch. As you continue on your investment journey, I would like you to always remember that information never sleeps, that every move has a meaning, and that the early bird sees the trend. Preparation fuels performance. So prepare, prepare, prepare. Today, these principles remind us that knowledge is power, timing is opportunity, and discipline is the key to lasting success. By staying curious and prepared, you position yourself ahead of the market. Ultimately, it's consistency, not chance, that builds real wealth. The reason I created the Stock Network is to give every investor an edge. In a world of pre-market trading, information you can digest quickly and confidently. Our platform is designed to be your trading toolkit. Speed and clarity are everything. While institutional investors and algorithms are scanning through, we are simplifying the noise for you, delivering those key signals from earnings and dividends to the critical red flags, empowering you to understand what's happening and why before the rest of the market even wakes up. It's about giving you the real understanding and confidence to move early and wisely. Please reach out to me directly. I would love to have you join the Stock Network. For now, thank you for joining me. Thank you, Tiger, for inviting us on, and I wish you all trading success. If you have any questions, please don't hesitate to send them through. Now, I'm just wondering if there are any questions that have come through at all. Okay, so I can now see that there are two questions, and I'm going to introduce you to my colleague, Tony. Tony, we call our resident expert because he advises us. He has spent, Antonio, the first question that I'll get you to answer is how can investors differentiate between real buying and probing orders in the pre-market? While you think about that, I will introduce you. Tony has spent more than 40 years as an analyst and analysing companies in Australia. He has worked for major banks, he has worked across all sectors, and he has worked for a significant amount of listed companies in all capacities of their investor communication, and also as an investor himself. So he's very well placed to answer your questions today. Please feel free to send them through. But that first question again, Tony, I will ask you, which is how can investors differentiate between real buying and probing orders in the pre-market?
I would say that real buying is something that is attached to new news. If you don't have that news flow and you've got probing buying, which you call it, occurring, it would indicate to me that potentially there's an inside information story getting out there or something like that coming through. I've been around in markets for a long, long time, and generally you need, and by generally, I mean the vast majority of times, you need actual news flow to move the dial on where the share price was before the buying occurred and where it is now.
Thank you so much for that, Tony. The next question is, what are your recommended websites to go to for stock market news? I may have the first go at this, Tony, as you think about what your preferred places to go are for stock market news. Firstly, for me, I would just always say to go to the source. The source of stock market news, for example, in Australia, is the ASX announcements platform. There is no truer source than the compliance legal platform. So checking every day, if you type into Google ASX daily announcements, they will take you to that news feed, which is free to access, of all of the announcements that are coming out minute by minute, usually starting from around 7 a.m. and again going into the evening. So in any market in which you're trading, seeking that news from the source, and even if it happens to be a company, putting yourself on the company's news alerts, so the company itself sends those compliance announcements to you. Many investors don't realize that you can register with a company, a stock that you're invested in, to receive investor communications. And that's one of the best ways to ensure that news that really impacts the market is getting straight into your inbox. So compliance aside, of course, I would have to say the stock market. We would welcome you following us on any of our social channels, subscribing to be also on our newsletter distribution so that you can receive our monthly updates. And apart from that, I believe in every major market there are financial news publications. In Australia, the Australian Financial Review is very popular. Also, the ABC, our national broadcaster. And of course, globally speaking, Bloomberg, Reuters, CNBC, Financial Times, they're places that people like to go for the news. But from my perspective, as someone that has been a journalist and also investor relations advisor and director on all sides of that communication, I think it's really important that compliance news is number one. And you focus on what the company is saying first and foremost, and only use that commentary as general research purposes. Tony, how about when it comes to you? What would you say are news sites or places you go for company stock news?
Certainly a good starting point are those financial oriented newspapers. So as well to mention Australian Financial Review here in the US, you're talking Wall Street Journals, the Barron's, these sorts of journals as well are very, very valuable. But I would also recommend that you try and get a bit ahead of the curve a bit. If you have shares in your portfolio and they're major shares, they will have a financial calendar. They'll tell you when their profit results are coming out. So you can be prepared for when the announcement comes out. In the Australian context, that's important because most of those announcements occur before the market. So that gives you the opportunity to absorb the news and then also as well prepare a reaction in terms of the trading day and whether you want to buy more shares, sell more shares in those companies. I would also as well try to set up a watch list of your preferred stocks. That's another option. And the final thing that I do, I look at market index or those sorts of financial sites, and they provide you with the top movers and bottom movers for the day. And if something's moved by 50%, There's a story behind it, and they're the windows to give you a view on what's happening on the market on the day, and then you can click on that 50% mover and see what's driven it, and then do your due diligence and understand whether it's noise or it's genuine market story that's going to move that stock over the longer term.
Excellent. Now, our next question, Tony, I'll read out to you. And again, I'll have a first go while you can have a think about your answer. But the question is, how do traders use pre-market data to shape their intraday strategies? So from my perspective, it's really using this data as a bit of a preview of the day's playbook. So it doesn't really tell them everything, but it really gives them strong clues on where opportunities or risks might sit once the market opens. And there's a lot of ways that you can really use this data to shape your strategies. Things like spotting directional bias is one, also identifying key levels, things like highs, lows, and like the volume weighted average price, and filtering of catalysts as well. So, Tony, I would love to hear your take on this question, which is, how do traders use pre-market data to shape their intraday strategies?
From a stock-specific perspective, it's pretty easy. If you've got a major bank or a major mining stock in Australia coming out with results that are above market, or they, more importantly, from a look-ahead perspective, their guidance statement is quite strong. That's self-evident. There's potentially a buying opportunity there, as long as things don't get too mad early on and you miss that opportunity in initial stages. When it comes to economics or political events that occur pre-market, that gets a little tricky. You've got to work out what it means for different sectors. Sometimes it's pretty easy. If the US government puts a 50% tariff on Australian meat, it's self-evident, and Australian meat is a major send through to the US markets, exported to the US markets, well then, yes, it could impact those companies. They have to find other markets. But other times, things like an unemployment number, okay, yes, the US economy is potentially slowing, but you've got to work out what that means for stocks, US stocks you got, and also as well what it means for stocks in other markets. So there you have to do a little bit more research to work out the ramifications of that, with due regard to the fact that all markets are interrelated, and that is trickier.
Excellent. Thank you so much, Tony, for those insights. Now, the next question is, what sectors tend to react most in pre-market trading? I might start by giving some examples. And Tony, maybe if you could even think of times that you have seen this in action play out. So in pre-market trading, as you can imagine, not all sectors move equally. The ones that are going to be reacting the most are usually ones with overnight news catalysts or global sensitivities. As we mentioned, even commodity prices or currency moves are moves that are happening all throughout the night. When it comes to specific sectors to watch out for with tech, I would look at things like earnings or analyst calls. We often see when we wake up in Australia, someone has said something about Tesla and their stock has moved. Also with healthcare regulatory results or updates, when the Trump was elected and the FDA was in flux, we would hear about that every day, a development with the regulator in the US and how that impacts biotechs here in Australia. When it comes to energy and commodities, global prices for both and how they will impact these subsequent sectors. And finally, when it comes to financials, looking at things like macro data or geopolitical moves. But the general rule really that sectors with overnight global inputs or time-sensitive news flow are going to be the ones that are reacting the most in the pre-market. And Tony, do you have anything to add to that, or any time you've really seen this dramatically in action?
I'll speak in terms of the Australian context. When big events occur overseas, unless it massive ramifications for the global economy, companies in Australia like banks and retailers who are domestically focused will not be impacted too much. However, here is another example of another sector that does get impacted. When China has a plenary session and they decide to increase their economic growth for the coming year, well, that could potentially have positive impact for our iron ore producers, BHP, Rio. That's one example. When there's a big rush on the Magnificent Seven IT stocks in the US, and people think, oh, there's a switch from one sector into IT. Well, there is oftentimes a trend evolve in the Australian market where people buy some of our IT stocks, even though they're not Magnificent Seven type standard. They also play that game and they get out of, say, consumer staples into IT. So they're the sorts of things that you've got to think about. If there is an economic or a political event occurs overnight that cause, and I use the expression, and I think you'll understand what I mean, fear and loathing in markets, people will go to traditional safe havens. And one of those in global context, of course, gold. So if people go into gold, that tends to lend support to our gold producers in that next trading session. And there's a few examples for you.
Thank you so much, Tony, for your insights. I would also like to thank everyone for joining us today. Thank you, Tiger, for inviting us on. And again, I would love to have you join the Stock Network. If you'd like to be involved in any way possible, even as an audience member, please reach out to me directly. Or if there are ever any CEOs you would like me to interview, again, let me know. I'm speaking with stocks and reporting on them every single day. I wish you all the best for your trading success, and thank you again for joining us today. Have a lovely day. Thank you.